Hi viewers! Bitcoin and cryptocurrency mining is a fundamental process in the operation of many blockchain networks, particularly those utilizing proof-of-work (POW) consensus mechanisms. In today's video, we're going to look into decoding Bitcoin and cryptocurrency mining in order to stop fraud and add new blocks to the blockchain, which creates new Bitcoins in a decentralized way. The process of confirming and recording transactions on the Bitcoin network is known as Bitcoin mining. Peer-to-peer transfers using Bitcoin, the first decentralized digital currency, are possible without the use of middlemen like governments, banks, brokers, or agents. Regardless of location, everybody on the network may send and receive Bitcoins. Users have two options for obtaining Bitcoins: mining or online purchases. In addition to being an investment tool, Bitcoin may be used for online purchases, mostly for the purchase of products and services. Bitcoin is a decentralized cryptocurrency that provides cryptographic security, reduced transaction costs, and speedier asset transfers. Because it is decentralized, there are no middlemen and transactions cannot be hacked or counterfeited. All transactions are visible to the public on a ledger that is open to viewing. To improve cybersecurity abilities for Bitcoin mining, a thorough cybersecurity bootcamp is offered. Participants gain knowledge of cryptographic protocols, decentralized system security techniques, and blockchain technology. Through practical instruction in network security, digital forensics, and ethical hacking, the bootcamp prepares participants to mine cryptocurrencies and defend against ever-evolving cyber threats. In cryptocurrency mining, new digital coins are created and recovered through the completion of challenging riddles, blockchain network transaction validation, and distributed ledger addition. The public distributed ledger known as blockchain, which records transactions in chronological order and protects them from hackers, is the foundational technology of Bitcoin. The smallest unit of a blockchain is a block, which contains all transaction information. Hash data, nonce, and previous hash are its four main features. The hash, which represents the block's digital signature, is produced by running the SHA-256 algorithm with the block's contents, nonce and previous hash value. Understanding the three main components of blockchain: a public distributed ledger, SHA-256, and proof of work is necessary before one can comprehend Bitcoin mining. All transactions recorded in the blockchain network are kept on a distributed ledger, which is verified by individual Bitcoin users. By employing a one-way function that yields a fixed 256-bit output for each input string, SHA-256 blocks unwanted access. Miners must solve a mathematical challenge as part of proof of work in order to provide a hash for a given block that is lower than the network's goal. Bitcoin Profit is an automated cryptocurrency robot that minimizes human participation and saves time by identifying trading opportunities in the cryptocurrency market using an AI algorithm. It states that, under typical market circumstances, about 85% of its transactions result in profits. However, computing the earnings from mining Bitcoin requires technical knowledge. The profitability of Bitcoin mining has declined recently as a result of falling Bitcoin prices, more competition, more expensive technology, and growing power expenses. When Bitcoin mining first started, it was done with CPUs and simple AI algorithms, which made it less expensive and more profitable. While both conventional money and Bitcoin are digital currencies, traditional money is a government-issued and controlled currency, whereas Bitcoin is the first and most well-known cryptocurrency, protected by encryption. Because there is no centralized authority, blockchain is a decentralized peer-to-peer network that is extremely transparent and safe. Mining Bitcoins requires choosing equipment, including a hardware GPU, mining software, a wallet, and a favorite mining pool, then mining the data on its own. Three components are involved in a transaction on the Bitcoin network: the money, the transaction input, and the output. Every input is given a unique cryptographic hash problem by Bitcoin mining software, which organizes the answers into a Merkle tree. A data structure of hashes in a block called a Merkle tree is used to efficiently validate transactions. The Merkle root, version number, Merkle root from the previous block hash, timestamp, cryptographic nonce, and target are all contained in the block header. Miners utilize the difficulty requirement, which modifies when every 2016 blocks are generated, to locate the hash below a certain threshold in order to solve the hash puzzle. Every 10 minutes, a block is added to the chain once it has been authenticated and transactions have been confirmed. more bitcoins are able to circulate since the first miner to obtain the proper hash value receives a reward in Bitcoin. Because of the limited supply, the 21 million Bitcoin upper limit imposed by its creator, Satoshi Nakamoto, is viewed as a major benefit. Bitcoin mining ensures that blocks of transactions are produced and stacked in the correct sequence. Since its launch in 2009, more Bitcoins have been mined and put into circulation. Every 10 minutes, the blockchain's architecture creates new Bitcoins, and each block that is mined yields a predetermined reward. Blockchain stops data manipulation and is impervious to hacking. Every 10 minutes, miners create new Bitcoins using mining devices like eBang, Antminer, Minidollars, Avalon Miner, and others. Users must construct a safe Bitcoin wallet and invest in a robust setup made especially for cryptocurrencies in order to mine Bitcoin. The process of mining starts by downloading a soft copy of the blockchain and selecting the Start button, following the installation and configuration of mining software. Bitcoin mining at home is difficult and needs certain preparation in order to be successful. The initial stage involves correctly configuring the devices and looking for a reliable power source. Installing efficient mining software, such as Awesome Miner, Easy Miner, and Pionex, is the most crucial step. Though it takes a lot of time and energy, mining Bitcoins at home may be beneficial. In order to determine their break-even price before investing in expensive hardware or equipment, miners must do a cost-benefit analysis. Time, energy costs, Bitcoin value, and efficiency are some of the factors that prevent Bitcoin from making money. The halving of Bitcoin, which divides block rewards in half, contributes to the stability of both the inflation rate and the number of new Bitcoins sent into circulation. The next Bitcoin halving is anticipated to occur in early 2024. The last one happened on May 11, 2020. Since its inception, Bitcoin mining has seen substantial change as the blockchain idea has emerged. ASICs, FPGA chips, SSDs, GPUs, and other specialized equipment are needed for the mining process. These gadgets are expensive to set up and demand a high degree of technological know-how. As a result, individual miners make little money. It is advised that people join mining pools, where a group of miners may collaborate to boost their chances of winning prizes. Bitcoin mining profitability can be assessed using a Bitcoin mining calculator, which considers factors like power usage, efficiency, difficulty, time required, and Bitcoin's value. Miners should continue operations only when there is a significant profit margin and low electricity costs. ASIC miners generate 100 terahashes per second and cost between $8,000 and $10,000. Developed countries may have an advantage due to reduced electricity costs. However, Bitcoin has risks such as irreversible transactions, lack of government controls, volatility, higher utility and processing costs, security flaws, and limited adoption. Electricity usage is another factor affecting Bitcoin mining profitability. Daily kilowatt-hour consumption can be estimated using an electricity cost calculator, and the monthly electricity bill can be calculated by multiplying the result by 30. Investments in companies manufacturing common Bitcoin mining gear, such as GPUs or ASIC devices, can increase profitability. Pool mining gives miners the opportunity to raise stakes, split energy expenses and risks, and be paid for finding blocks. Due to the larger earning stakes, it is less expensive and more stable. Share difficulty and time are taken into account when calculating rewards, with more skilled miners earning higher percentages. Each miner is required to provide share records, but the network automatically determines the sharing difficulty and time. Thank you for watching this video. If you liked the video, don't forget to subscribe our channel and leave a comment in the comment section below.